Good morning, everyone. We are Mortgage Pros 411. I'm Audrey Boissonou with Kevin Casey, and today we are joined by Doyle and Tom Werder. I really want to do German. I want to go Werder, Tom. I really do. But
That's how a college professor called me out in class one day.
really, yeah, I had a
Yes.
French teacher tell me I was saying my last name incorrectly too. So, yeah, for sure. And consider you were at Tomei a few minutes ago before we changed your name on the screen. We're doing great. All right. Well, good morning, everyone. It's very nice to see you, and thank you for joining us. So, a few little things before we get this thing rolling. It is Jobs Weeks, kids. So Wednesday we have ADP. They're expecting 150,000 new job creations, and Friday we have my favorite BLS. Just for you two guys, I refer to as the BS jobs report because it is usually wrong. And the massive revisions after they have moved markets one way or the other, usually in the crappy way, are incredibly, they're just ridiculous. So they're expecting 200,000 job creations this month. Last year we had, good grief, last month we had 353,000 fake job creations, because if you looked at the raw data, we were really down like a zillion, and but it was the imputed numbers that they're using. So they're using these modeling and the seasonal adjustments, and all of that is really shifting these numbers so that they're not exactly what they appear to be. So we have that to look forward to on Friday. Yay. 3.7 is our unemployment rate, and they expect that to stay the same. We also have next week, March 20th, the Fed meeting. And what moves markets more than the meeting? The comments after the meeting. So just be on alert on Wednesday, because that's coming down the pike. In the meantime, we have green in the markets in bonds today, and our 10-year treasury is under 4.2. Like it was 4.15 last time I looked. So that's a nice thing for a chain, isn't it? Just in case you have noticed your gas prices going up, OPEC decided that they were going to extend their production cuts into Q2 of 2024, and demand is not what they thought it was going to be. So guess what, kids? Oil prices are 80 bucks a barrel around there at this point. So that's going to factor into our inflation numbers. So anyway, there's a lot going on out there. I also thought it would be interesting to note that in 2023, 86% of lending was purchases. In 2024,
86%?
86%. That's right.
Oh.
In 2024, 75% is what they expect to be purchase volume. And in 2023, 91%. That's right. 91% of the refis came from cash out. So they are expecting a 25% increase in originations in 2024. So they're expecting that we're going to go from 1.6 trillion to somewhere in the neighborhood of 1.9 to 2 trillion. But as we know, often those numbers are wrong. So take that with a grain of salt and be happy that we are talking today about a new loan product that could help increase your origination business in 2024. And with that, thanks, guys, for hanging in there while I went through all that. I want to start with our subject line today, which is us claiming that this is the first new loan mortgage since 1991. And I said, can we really say that? And I was assured that the attorneys have vetted this. So can you walk us through how is this the first new mortgage product?
All right, that's great. Thanks, Audrey. Thanks for having us on today, and couldn't agree with you more about the BLS numbers. They are the BS numbers. So you had to kind of chuckle.
Thank you.
It is the first new. The last time that we all created a new mortgage product was 1991, and that was the indexed ARM. Before that, it was the reverse mortgage. Before that, it was the fixed mortgage. So there have been variations of mortgage products. We have the IO. We've had various things, that bells and whistles, but we spent we spent the entirety of last year and part of the year before creating a shared appreciation mortgage product. And I'll talk about the familiar, which I think all of us perhaps on this call know about, and then the unfamiliar. So it is a 10-year maturity with a 4.5% coupon.
Well, hang on. I just want to back up for a second, because we're going to start with, so first of all, your attorneys vetted the claim that we have the first mortgage that was created since 1991, right?
Yes.
Okay, great. All right. Just want to make sure we're super clear about that. Like the attorneys blessed it. There we are.
Not
You
just
didn't make it
one
up, Audrey.
firm, 2 firms.
2 firms. Okay, so 2 is better than 1 when
Yes.
vetting things, so that's
Uh-huh.
great. Okay, and just I want, as we get into what we're going to talk about today, which is shared equity, I just want to preface that by saying we've mentioned it, we've talked about it before. We had Bill Dallas on last week. It's his favorite thing, and Bill Dallas maintains that we have one product in the mortgage space. That would be a 30-year fixed mortgage. That's all anyone thinks about or does. And there's something to that, right? So this is a shared equity product, and we're going to take a dive into it. I will also say that we're going to talk about it today, but there are FAQs on their website that will knock your socks off. So apparently they spent like a quadrillion dollars on making sure they put those together. And so I invite you to read them because I did and actually learned a lot. Can you imagine? So it's a good place to get some questions answered so that you're not, asking questions that have already been answered. So we're going to talk about shared equity. So Pat, let's start with you. We have what do you call it? Let's start there.
I call it the way I like to describe it is the familiar and the unfamiliar. What's familiar? 10-year maturity. It has a note rate. That note rate is 4.5%. That is very deliberately set close to the treasury market, which it was closer to before the rally today. But it's very deliberately set there. The interest is deferred. Otherwise, we all know we call that negative amortization, and there's a balloon payment in the end. As a mortgage, we allow partial prepayments and prepayments at any time. There is no prepayment penalty. What is unfamiliar is in exchange for the 4.5% note rate, which I think we'll all agree is below market.
Correct.
As a note rate, right? We're actually at NewFi and at other shops, we're doing closed-end seconds and HELOCs with borrowers that would fit the same profile anywhere between a 9 and a 10%. So in exchange for that, and in exchange for the investor not receiving any payments for up to 10 years, we share in the appreciation of the house. And how that works is that if the borrower borrows 5%, we share in 15% of the future appreciation. If the borrower borrows 10, we share in 30. If the borrower borrows 15, we share in 45. We never want to borrow more than 48%. We never want to be over 50% appreciation. Therefore, we cap the LTV on the loan at 16%.
60, right? 60, 60. Or you just said 16. Okay, 16 for your loan. And then the CLTV is how much again?
60% if you're backed by a 30-year first lien, and 65% if you're backed by a 15-year first lien.
Got it. Okay, got it. I just want to make sure I don't mix up the 16s and the 60s. So
yeah, something to be clear on too is we're not sharing any of the past appreciation a borrower has built up, and we're not sharing 100% of the appreciation going forward. And I used this term, Audrey, when we first met. I don't like going down the rabbit hole, but suffice to say that because that 3-time sharing ratio is constant, if we convert all of what I just said into an interest rate, it becomes the same interest rate. So, and why that's important is because we're a mortgage, we adhere to the various state high cost limits and the various usury limits, and we cap ourselves somewhat arbitrarily in terms of what we'll charge the borrower. We are not, as structured, we are not a high cost mortgage. And I explained this to some folks the other day. And so they said, well, why did you cap it? Well, our assumption is that the regulators will come along someday, want to see some uniformity to the market, and say, you know what? We've got to come up with a different system. And the one system that Tom and I can point to right now is the existing high cost limits. So we are not a high cost loan, but our investor and NewFi, as we structured this in consultation with the 2 law firms that said it's the first new mortgage since 1991, said it's probably a good idea to opt in rather than to push the buttons and test the system.
okay, so you're getting in front of what you think the future regulations will be.
Yeah.
Because when I talk to, and I've talked to a few people as I have adjusted to this whole idea, I think I was pretty clear and have been on here actually that the first time I heard about shared appreciation, I'm like, no thanks. And I've really evolved from there. And so just keep an open mind, people. This is not for everyone. And these guys are aware of that. They're not suggesting that you go to your entire database and tell everyone they should have one of these. But there is a specific niche of people who would be interested, who would qualify, and where it would benefit them. And we'll get into, why would somebody do a different loan or do this one instead. So, okay, so we have no payments. So that means that you can take, or you could make payments, right? I mean, you could.
Yeah,
It
you
would
can.
make a lot of sense because then you wouldn't be taking advantage of the fact that you don't need to and putting that money to better use, right?
I mean, if you want to listen to Warren Buffett, you want to keep your reserves, you want to keep your money at Schwab, you want to keep your retirement accounts earning money and compounding. But if you've got disproportionate wealth in your home, let's take the couple in their 50s and both have built up some reserves in a 401k plan, and they've got some money over at Schwab, and they're not at retirement yet, but they say, hey, I might want to go buy a second home, or I might want to do something else. But why? I got a bunch of equity in my house, right? But I really don't want to reduce my free cash flow next month. I don't want to sell the Schwab account to go make the down payment on the vacation home. Here's what I'll do. I'll do equity choice. And for the next 10 years, my free cash flow is identical the day after I take out the loan than the day before.
That's right. So it's this, again, when you get into these kind of loans, they are for a sophisticated, borrower who understands the value and why would I do this? And then they're going to take that money that they're not spending on a payment and they're going to use it somewhere else where they're going to make more money. Am I right or am I wrong? Correct me. Feel free to dive in and tell me I am off the mark anytime.
No, that's spot on. For the borrower that wants to do debt consolidation, and is let's just put it a little more stressed and has a real need for the money to carry themselves for the next few months, this isn't the product. Right. This is the product for the person that wants to keep money working. Yeah.
Yeah. Like I just had one of those where client was buying another property, needed $200,000 for the down payment, and we just did it cross collateral, and but the rate was 10 and change. And it totally made sense because they would have taken a huge hit if they liquidated their retirement money to do this transaction.
Right. And people don't think about this if they're pulling money out of their retirement assets, they pay a penalty.
Right.
Yeah. Huge.
And for California, it's actually, when you add federal in California, it's 12.5%. Then it immediately becomes ordinary, right?
Yeah.
Exactly.
At the same time, I sort of joked around about the person selling their stuff at Schwab. I never joke around, Audrey, so I'm not literally joking. This is serious.
Okay. The reason he's saying is that I keep telling him he needs to smile more. So smile before your next comment. I'm not very good at that. Pat.
But anyway,
he smiled once. We're done.
Yeah, but the person that sells their stocks at Schwab to go fund whatever they're going to fund, they're paying capital gains.
Yeah.
Or in some environments, when the stock market's really crappy, like we had about this time last year, you're selling out at the low. So if you got a 3.5% mortgage and you got all that equity sitting in your house because home prices have ripped, which they have, this might be a good decision, but it depends on the circumstances of the borrower.
Okay, so the reason I was shuffling around is I dropped a whole pile of things and managed to pick it up without falling out of my chair on my face. So that was good. But I was also looking for the piece of paper where I wrote down a comment that you had made previously that $76 billion is withdrawn from 401ks in 2022.
That's shocking.
$76 billion. I just was blown away by that number. So again, when you take the 10% penalty plus the tax, to your point, Pat, I mean, it's astonishing that people are paying those numbers. Pardon me, what'd you say, Kevin?
And then the loss of income.
Yeah, I mean, you're paying taxes, you're getting rid of your investments, it just goes on and on and on. So again, when we look at that kind of thing, there are people out there, they're trying to access their assets and they're tied up in their 401ks and their equity positions in their homes. Yeah. And so that's what this is all about. Okay, so moving right along. So we've got a loan where they can get, what is the minimum and maximum loan amounts?
We go from $85,000 to $500,000.
Okay, great. And so, and no payments, 4.5%, and you use a shared appreciation value. You have shared appreciation, as we know. Do you have something you want to show us on that, or do you have any slides you're going to want to share?
We can.
No, you don't have to. I'm just offering just in case. I should have asked that earlier. Sorry.
We can swing back to that. Maybe Tom,
Yeah,
you could
okay.
wrap.
Okay, let's talk about reserves on this thing. So for your borrower, what kind of reserves are you looking for?
It is because of the nature of the loan. And I mean, look, if you bought a house in California in '89 and you get out of this loan in '97, you owe 4.5%. There is no shared appreciation. A lot of people don't remember those times. If you got into the house in '04 and you get out in 13, you owe no shared appreciation. There is no shared appreciation. We all know that. But there can be environments where there's a lot of shared appreciation. So using the mortgage speak, we're all in the mortgage industry here, in order to qualify for ATR, one of the things that we require is that the borrower have reserves or assets that are equal to 110% of the loan amount.
Mm-hmm.
Sounds like a really large number, but let me just give you a stat because that's what I do. The press likes to talk about half of America doesn't have retirement assets. Well, you take 1 minus half and you get a half. So there's half of America that does have retirement assets, and that average balance is $256,000 for the statisticians out there. Wow. So there are people with plenty of assets because we at NewFi, in addition to all the other things we do for ATR, we don't haircut the assets. Right. So if you've got somebody that's got some money in the bank, they can have loans, they can have a first lien, a car loan. That's not the point. But if they have money in the bank and they have retirement assets, they're pretty easily going to qualify for our loans, given they also have to be the primary residence of their home.
Okay, so hang on a second. So there's two things there. First one is when he says haircut, he means like, how you go to a lender and you give them your 401k and they only let you use 60 or 70% of the value of that 401k. They don't do that. So if your 401k is 100 grand, they are going to give you credit for 100 grand. That's it. It's across the board. Correct? Okay. Just want to make sure. And this is an important thing, this owner occupancy thing. So not only do you have to have an owner occupant, they have to have been in the property for 2 years, right?
Correct.
You're looking for stability, people who have shown that they know how to own a house and make a payment on it first, presumably, right?
Yes.
Okay. All right. Good. All right. So now that we've defined haircut, let's see. Is there anything else you want to talk about before I move it over to Tom, Pat?
Just one. There's probably one thing I should suggest, because I'm certain there's people listening right now that are familiar with the fintech equity option products. And I'm not here to talk about the fintech equity option products, but I will say that those are not mortgages.
Right.
They are not subject to the mortgage regulations we all know and love.
You're basically selling a piece of your property. Yes,
they're not issued in any manner, way, shape, or form whereby we're issuing and distributing this product. They are also not subject to the mortgage regulatory caps that we've opted into, which means in a very rapid price appreciation environment, I haven't seen, and every program's different out there, I haven't seen a mathematical scenario where our borrower is going to be anywhere near what they might pay in a fintech equity option scenario. So that's the first thing. The other I would call one of the interesting things we did in structuring this product is we had 3 goals. All right. It had to be capital friendly for the investor, had to be REMIC eligible, right? So it could be securitized. REMIC, R-E-M-I-C. It's a tax regulation and law. Why is that important? Is that if some of the people on this call today are interested in the product and want to invest time and effort into figuring it out and marketing it, it's important that NewFi continue to have capital, and the people that come in after us and do something similar continue to have capital to support the market. So the fact we were able to achieve both of those things bodes well for the future. The third thing we did is we incorporated a home price index to make it convenient and easy for the borrower. So what do? We ask the borrower, when we originate the loan, we appraise the house. So what's the value of the house on day one? What we do in the future is we look at the future value of the CoreLogic index. We compare that to the value today, and that is the percentage change in the home value that goes into the home price appreciation calculation. Most people don't know this. Some do, most don't. I actually didn't know. We all hear about CoreLogic sort of on the fringe of the mortgage market in the context of the Case-Shiller Index, because that's widely quoted on the news. CoreLogic actually tracks home prices by zip code across the United States. What this does, this is really long-winded, Audrey, but I have to get through this.
Okay.
What it does is it means that we can process prepayments no differently than any other mortgage. And what we've heard in the little under 2 months we've been marketing it here at NewFi is there's a lot of confusion, because in the fintech space, A, they don't allow prepayments, generally speaking, and B, actually doing your payoff is quite an onerous process. Our payoff's no different than a closed-end second. Calculations available 365 days a year. We run the calculation. Borrower partially prepays or the borrower pays.
All right. That it is good to know. And I like CoreLogic a lot. We're going to have their chief economist with us in a couple of weeks, which I am very excited about. And so that is a solid, great index to be following as far as appreciation. We call it, according to MBS Highway, the gold standard.
Yes.
So that's good to know. Great. All right. So Tom, tell us, how does it work?
It's actually a fairly easy process in order for a broker to engage with us. They're basically taking a short form application, which I'll call a pre-qual, answering 10 basic questions, and then registering that loan with us, and then sending it over to NewFi, where we take over and really do all the heavy lifting of the application, processing, underwriting, closing, and funding of that loan. So it really takes all the heavy lifting off the broker, allows the broker to focus on their core book of business, and we update them throughout the entire process, so they can always answer any questions or come to us with any questions that their client may have. And the one great thing about this process is, if at any point in time that client opts out of the equity choice product, we're pushing that client back to the broker to serve their needs. We do not want to cross-sell any other product to them.
It is really important that we emphasize this, because a lot of LOs are control freaks, and our clients are our babies, and we don't want anyone else messing with them. So to be super clear, we're going to push this borrower to you just for this. And if there was any other question ever about any other product or anything, you're going to send them back to the original LO, correct?
Correct.
Okay. Now, just a second side note on that. That LO needs to then pick up the ball and actually follow through. So we occasionally hear about LOs not doing that. So I just want to remind everyone, we have a part in it. We have to do our part. So, okay, keep going, Tom.
And definitely want to keep everyone abreast of what's going on with the loan throughout the entire process. So the LO will be getting emails as that loan hits different stages, so you're not left in the dark. And you can always pick up the phone and call us and say, hey, look, I don't understand. Can you fill in the gaps? And we'd be happy to answer any of those questions for you. So it's a very simple process. And the way we kind of look at it is, how much time do you spend on a closed-end second or a HELOC trying to get that application, getting all the documentation process, getting it submitted to your lender, 6-8 hours worth of time, and the compensation probably isn't as great as you would like it to be. Our process is probably, an hour at the most, right? And it's a very benign, very simple process for the broker to go through with the client. So.
Well, and I went to your little calculator that you have on the website, and I put in some information, and it was super quick, and B, if you put in some information that doesn't jive with this program where it's not going to work, it prompts you. It lets you know what the deal is, why it's not working. And then if you have further questions beyond that, you would just reach out to your AE, right?
Correct.
Yeah.
Yep.
So if you're like, why on earth not? Why? Right?
Yeah, I mean, that's a great point. The pre-qual application process really is going to help you get through there. And again, this is not that we're expecting to run a credit report. We're not expecting to run AVMs. This is all verbal information. that you're getting from your client,
Mm.
make it as simple as possible, and then we do all the heavy vetting. So
That's
it's-
great.
Yeah.
But it's a full underwrite, right? And you're looking
Right.
for a 680
Full-
credit score. Yeah.
680 credit score, 45 total back-end ratio, full doc loan. I typical Fannie Freddie type underwriting guidelines, just a blanket statement. Again, full doc, and again, we're collecting all of that documentation directly from the borrower.
But that,
It's important to note on the back end ratio, since equity choice is not a current pay instrument, that does not factor into the back.
Right. That's what I was trying to.
We don't do any assumed payment on that whatsoever.
So if they
Okay.
have a 45 back-end ratio before they apply for this loan, they have a 45 back-end ratio after you fund the loan. It's the same
Perfect.
ratio.
But with that
Correct, if
being
they
said,
don't take out any other loans in the process.
Yeah.
no, we'd beat them if they did that. We have a process for that. So if they have debts, for instance, that they're going to pay off with the proceeds of this loan, we're not going to be able to exclude them from the DTI, it sounds like, correct?
Correct.
All right,
Correct.
just want to make sure.
Now, just to point out, they can use those funds afterwards for whatever they want, but
Right,
to the point,
right.
they can't use that for qualifying
So
purposes.
as a LO, if I see that their ratios are a little bit high, I might want to advise them to maybe get their ratios down and then apply.
Correct.
Got it. Okay,
Yep.
great. Okay, so let's talk about some examples of how this is working for people right now. Like, you have loans in your system, you have people that you've helped so far. Who are those people and what do those deals look like? Why did they choose this over a HELOC or a fixed second or why?
I mean, the people that we see that are filling out the profiles and starting the application, they have a lot of housing wealth. They generally have got 50% or more equity in the house. This won't be a shocker to anybody. They're all, generally speaking, in that cohort of people that refinance down below 4%. They certainly aren't going to refinance their first lien.
Mhm.
And they're looking at a 10% HELOC rate that requires them to draw 75%. And it's compounding or negatively amortizing just as well. So they're looking at those factors. We've had a few people that understand, some people that own businesses find this to be a very interesting loan to be used in lieu of a small business loan or a factor loan. There's been some conversations as it relates to that. We had someone call in the other day that happens to live in Southern California. They're building a house in Colorado. They're midway through construction. They've got plenty of equity in their home in North County, San Diego, and they want to add a bedroom now. So it was going to be a 3 bedroom. Now they're turning it into a 4 bedroom. They need another $200,000. So, I mean, if you want a real life example, we were listening to that call the other day, right?
Lovely.
That person is in their late. I think that gentleman was 58, if I had to guess. Has 401ks and is going to retire years and wants to move out of his North County home and move into his Colorado home.
Mm.
So these are just examples of what, but most of all of our people, or we're hearing, they have a lot of equity. Their first lien's at a low rate, and they do have some assets, but they want to keep those assets liquid and over there earning money. That's the general theme.
Yeah, no, I looked at my database last week and it was amazing how much equity was the average person, $350,000, $500,000 easy per client, just like boom, boom, boom. And they all have a 3% mortgage and they're not leaving it. And so it's like, how do they tap this equity and, still do something they want to do? Now I want to just, so one of the things you're saying is that you guys basically triple so if you borrow $50,000 from you guys triple that as the amount that you are using for your leverage, correct? That's why you did the maximum of 16% loan to value. If you triple
it's 3 times whatever the LTV of your loan is. Right?
Yes. Now, is that what you pay back? Is 3 times, or is that what the appreciation is on that?
You share, that's the percentage in appreciation you share in. So you owe at maturity, or whether it's a function of a partial prepayment or full payoff, you owe the principal, you owe the interest at 4.5%,
Yes.
which is, pick interest at 4.5%, and you owe whatever percentage of the future appreciation you agree to share.
Okay.
So if there is no appreciation relative to our initial mark on the property, then you only owe the principal plus the 4.5%.
Principal plus the 4.5%. Okay, if there is appreciation, let's say the appreciation went up 3%, which is pretty typical, and it's a year later, and you borrowed $50,000, you owe the 4.5%, and then you owe the 3% appreciation.
If it's $1 million home, let's do this. Here we go. Here's our example. It's always better. It's always easy. Let's take $1 million home and assume you're going to borrow 10%. You want $100,000.
Yep.
We will take the $1 million home and we will assign an initial agreed value of $950,000. So that's our starting value on that.
Okay.
That's to account for appraisal variance and index noise in the future, that discount. So we're going to share in 3 times 10% or 30%. So if you go down 2% per annum, as you can see in the light blue, you only owe the fixed interest amount of $56,000. You owe that amount regardless. You owe the $100,000 regardless. If there's no change in the value of the index, your final payment will include a modest amount of shared appreciation that's really the difference between $1 million and $950,000 times 30%. Okay? If we go up 2% a year, you're going to owe $80,000. If we go up 6% a year, as it relates to California, you are not going to owe $252,000 of shared, you're not going to owe $252,000 of shared appreciation because that amount is capped. At a 6% annualized home price appreciation, you will run into the cap in California, which is currently a 12% rate, approximately a 12% rate. So that 6% scenario, Kevin, that approximates 2013 through 2021. That negative 2% scenario approximates 1989 to 1997 in California. So pick your poison is the way to think about it.
Well,
But-
and we have people listening across the country who, they may be in places that didn't historically have a lot of appreciation. Now it's getting better. But what I also found was interesting in some of our conversations with other people who have equity share, but not a mortgage, that they're not interested in going into the other states, that they want to be where there's a lot of appreciation. They know it, they can count on it. And you are in a lot of states and are growing and are not so focused on that, which I found interesting. So where are you right now? Which states are you in?
I'll cut to the chase. We're going to be in about 34 states.
Perfect. That's close enough.
We will be there by the end of the second quarter.
Okay.
And
Which is close.
Which is close. We are in California, Colorado, Arizona,
Illinois,
Illinois, Georgia, Louisiana, Oregon, Ohio. Everybody's now sending me notes so I know what states we're in. Let me say this. I just got bombarded with let me say this. Unfortunately, and it's not because of the shared appreciation feature, but we all know in the industry that Texas is pretty tough on second liens.
Yep.
We cannot do a second lien that has a balloon payment in Texas.
Got it.
We have an issue in Florida where they have an exceptionally low usury cap, and there's some regulatory consideration as to whether shared appreciation should be counted or not. So we're sorting that out. Virginia does not allow deferred interest or negative amortization either. So there are some states that either because of the negative amortization of the balloon payment, we can't go.
Right.
But we're in a lot of pretty big states. So we're in Georgia currently. We're opening up in North Carolina next week. We'll be in South Carolina. We'll be in Nevada, Utah, Idaho, all of the mountain states, unless you want to consider Texas a mountain state, but I don't. But we will be in Montana and Wyoming, and we're in Oregon. So it'll be a pretty good footprint across the country.
Right. Okay, so we're going to answer a couple of the questions that were in the chat. So number one, no, they don't do rental properties. So just to recap,
Correct.
this is straight out of past
Owner-occupied only.
FAQs. I want to make sure we're maximizing the FAQs that are on the website and all the information there. So I'm going to read from there. It is, you have to be a homeowner with an existing first lien. You have to have resided in the property as your primary residence for at least 2 years. That's really important. You have to have sufficient equity, approximately 50% or greater in your home. You need to have liquid reserves, assets, or income to satisfy the loan requirements. That would be 110% of the loan amount. And you have to have a FICO credit score of 680 or better. So that's to recap if somebody wasn't here in the beginning or somehow missed it. And allowable sources, I think this is worth mentioning. Tom, do you want to tell everyone what the allowable sources of reserves or assets are?
Yeah, checking, savings, mutual funds, IRAs, 401ks, etc.
Stocks, bonds, some
Correct.
business assets, it sounds like you can also use occasionally. It's on your FAQs, Tom.
Okay, I'll verify that for you.
Okay, that sounds great.
But I'd like to point out that we'll send out the link to the website that it is really informative and can give you all the information and point out the guidelines. We have the matrix up there, and then we also have the calculators, so you can do
Yeah, and we're going to actually send out an email with this video in it, and it will have everyone's contact information, all your information. They will be finding you at your Little League game on Saturday. There will be so much information on how to find you. So it was interesting because again, back to the FAQs, I can't say it enough because Pat really likes them. So there is, can I pay down my equity choice loan? And the answer was already yes, you can. How are partial prepayments calculated? And I was a little confused about, just because, there's this index shared appreciation amount. And so is it something that someone will understand when they get their payoff, how the payoff was calculated? It's not going to be some mystery, right?
That's a great question. No, it will not be a mystery. And most importantly, because we're going to provide information along the way via the servicer. So the borrower can track where they stand relative to shared appreciation. So let me give you an example.
Great.
Let's say you take out the loan tomorrow and home prices go down 7%. And you pay off half your loan at the end of the year. Jacks my servicing costs up, but you're allowed to do it. You pay off half your loan at the end of the year. Guess what? You're only paying 4.5% on half the loan. Now, if home prices then appreciate for the next 7 years and you pay off, we're going to measure the appreciation at that future point in time relative to the original point in time when you took out the loan. That will be your index shared appreciation, but you only owe it on a portion of your principal.
Got it.
So the investors didn't really like this, but again, as you can understand, they didn't think this was the greatest feature. But
it probably means it's better for the borrower.
As a mortgage, we have to allow this. So that's how we calculate it. So you can, so I mean, I've had people say to me, well, I'm going to time it, and my home goes down, I'm going to pay it. You can do that. You can actually take this money out and pay off your first lien. Again, you wreck my servicing cost, but it's a mortgage. You're allowed to do it.
Right. And they can use this to pay off a second mortgage?
This has to be a second mortgage. Yes,
right, they can use the proceeds to pay off a second.
Yeah, say they took out a crappy closed-end second at 10% or a HELOC, and hey, I'm just being competitive.
How dare you?
Actually, we issue them too, so I got to be careful. No, the point is, absolutely, they can pay off their second lien so long as at the closing table we're in second.
Got it. Okay, and somebody's made a comment, 100% of retirement assets, ? And so to clarify, you have to have 110% of the loan amount in reserves, but you can use 100% of your assets, including retirement.
Correct. If your 401k is worth 200,000 and you borrow 100,000, then you've clearly got 110%.
Right, right. All right. And you can use this to do whatever you want. I would highly recommend counseling your clients not to go to Vegas, but other than that, knock yourself out, right?
It's, yes,
Okay.
And it's deductible if you're doing it for business purposes or.
I would just like to pipe in with check with your tax professional, please.
Right.
Do not take our word for it, for God's sake. But apparently there are some ways that you can do that, right? There.
yeah, no, we can go down that, rabbit hole. It's actually, everything I'm about to talk about is not a function of the fact that it's a shared appreciation mortgage. The IRS didn't create some, great nifty rule last year because we asked them to.
Oh,
I mean,
really? That's shocking. Shocking.
if you do a closed-end second, or you do a HELOC, or you do a first lien, and you declare that you're borrowing that money for a business purpose, to fund your pizza parlor or to buy a rental property,
Right.
then you
Oh,
can
wow.
write off that interest against that business or investment income. You can borrow this money and participate in a limited partnership that buys a multifamily or an apartment building with a bunch of friends. You can do that. It doesn't make a lot of sense to do that if you're paying 10%, right? Like you're funding your apartment and your business at 10% via HELOC or closed-end seconds. But here, if you declare it's for business or investment purpose, you can write off the 4.5% note rate in the year that it accrues, but is not paid. I'm going to
Wow.
say it again. You can write
Yeah.
it off in the year that it accrues, but is not paid. So
That's a
that
big deal.
is that for your clients that are, let's call them the smaller time, or the people that might just have one or two rental properties. They can run the math on that. Any small business person can run the math on that. And that's a big, big lift. Now you got to consult there are some limitations on the use of this, not unique to this product, but if somebody goes to a CPA, they're going to hear back readily that this is something you can do because people have been doing it for 40 years.
Mm-hmm.
Interesting. Yeah, that's great to know and be reminded of. So just again, we're still getting these questions in the chat. No, you cannot exclude debt payments from the DTI included in the 45%. And then again, there is a calculator on their website where you do a little prequal and then you pass it on to NewFi. So it's fairly simple, it sounds like, and straightforward. Yes.
Yes, in order to access the pre-qual short form, you have to be approved with us. So
Good to know.
definitely, you want to give me a call to, if you're not approved with NewFi, to get that process rolling. And then we have a short contract or agreement on the equity choice product that you have to get signed. So pretty benign, but still have to get that executed.
All right, let's talk about Ella's favorite subject. How do they get paid?
How do they get paid?
Yes. How do they make money on this? I mean, just know we've all done a lot of HELOCs in our past where we didn't get paid or we got paid, not much.
Well,
And
sometimes, yes,
so
a lot of times nothing.
a lot of times
Right,
nothing. So
right.
tell us about that.
So you get the greater of $750 or 70 basis points of the funded loan amount.
Okay.
And again, you go back to my 8-to-1 ratio. I'm not sure how much you're making on a second today. Maybe 2 points on $150,000 is probably
No, but go ahead.
Oh, maybe I'm a little optimistic there.
I wish.
But,
Yeah. I also heard you state at one point, oh yeah, if you spend 8 hours on a second, I'm like, please. I had one that took me 16 years, Kevin. I swear to God, I started it.
Just recently closed it. Yeah, it took our months.
It
Right.
literally took months. I mean, partly the lenders, partly I had to change lenders. It was so dumb. Anyway, so yeah.
Right. So that's, paying
30 cents an hour.
Right. So we really want to do all the heavy lifting for you so you can get back to your core book of business and, not get frustrated with the process around a second, especially if you're not getting paid or you're getting paid very little. So
Right.
the compensation is for your origination services, and I think it's very fair and applicable to this type of arrangement. So
Okay. I'm going to read this because I don't want to mess up the question. Is the capped payoff amount fixed on when the loan is taken, or if that amount changes in the future, will it be subject to the change? Does that make
That's a-
sense to you guys?
That's a great question.
Great. Will you explain to me what it
Yeah,
means?
that's great. And what it means is, whoever asked that question must be familiar with how caps work. So in California, we have a Treasury plus 800 cap, and it resets on the 15th of the prior month. So it resets 12 times a year. And then some people might be familiar, they might have heard of what's called an APOR cap that's enforced by the CFPB. Many states default to the APOR cap. That resets weekly. So what we do is we take the cap rate proximate to the time we lock the loan, and that's the cap for life.
For life.
Okay. And
For
then
life.
it's
So,
fixed.
so your borrower doesn't have to worry. It's not some variable floating cap. That would be silly.
Right.
Okay. And the
So it
follow-up
really,
question,
frankly, it operates just like if it was an index arm. Think of an index arm. It's the cap proximate to the time the loan closes. It gets written into the documents.
got it. Okay, that makes a lot of sense, actually. And just to recap, because it's being asked again, you cannot be in first position with this loan. It has to be in second position.
You can end up in first, but at origination, we have to be in second.
Yeah, don't confuse things.
You
Pat,
can use the
you
proceeds
cannot
to
be
pay off
in
your first.
second position. I mean, in first position.
All
Okay,
right.
But
only
you
second
could use the
position.
proceeds to pay off your first, and therefore kind of creating your own little reverse mortgage where there's no mortgage payments while you have this. Well, of course, we have to say there's no mortgage payments. You still have to pay your taxes and insurance, but
And there's no age restrictions.
and no age restriction, correct.
No age restrictions. Isn't that something? Okay, so interesting. So you can subordinate this loan. That is possible. There are a couple of caveats around that, though. Do you want to tell us what those are?
The caveat to resubordination is if, let's say your loan amortizes for 5 years and you've lowered your principal amount due. If you want to go out and do a cash out refi, you can always do a rate refi. If you want to do a cash out refi, you can't cash out more, or the total amount can't be more than the loan balance, the first lien loan balance at the time of closing.
Got it. Got it. All right, that makes sense. And then,
Well, actually, but what if you only borrowed like, let's say $50,000, your house is worth $1.2 million and your current first mortgage is $200,000. You're saying that they can't suddenly get another $100,000 on a $300,000 second, they still be within your guidelines.
Yeah, but that becomes a future event. The answer is that would get very, very complicated and hard to enforce, because what if the home value has dropped 20% in between point A and point B?
so to
But
recap, no.
Yeah,
Or if they do, they take out a new loan, paid you off.
they actually could come and redo a first and an equity choice or something else. They can always do a cash out refinance at any point in time with whatever means they want. They can sell the Schwab account. They can rearrange everything, do whatever they want.
Right. Okay. Okay, let's talk about refinancing this after you have this. So a lot of, lenders want to see a 12-month payment history on a loan that you might have. And so what do you do to show them the note that said, or something that says there were no payments required and then you're off the hook? I mean, are you guys, you know what I mean? Like, how do we get around that requirement? Show us a 12-month payment history. Well, there isn't one because we don't have to make payments. This is when you're going to go refinance your first mortgage or anything else.
I think that's a good question. I think it's really going to be up to the new lender on what they're going to ask for, require, or be satisfied with. And I think similar to a reverse mortgage with no payment, you just show them the note. There's no payment required, and
Okay.
maybe it's a different approach in showing. I think earlier to Kevin's point that they were kept current on their taxes and insurance, and they weren't in default on this loan by doing so.
Tom,
Right.
you know how good Audrey is? We have never been asked that question in 4 months.
Occasionally, I have a thought in this little head of mine.
No. I know. See, I never contemplated that one. I'll leave it at that.
All right. Well, you might want to get on it and make sure you guys will refinance people out of this so that
No, we will.
Yeah, you will. All right.
You have to come back to NewFi to get a new loan to refi the whole thing, so.
Oh, okay. Yeah. Talk about cornering a market. Good Lord. No, but it is definitely something to think about because we're always thinking about what is our exit strategy? What do you
Right.
do in 10 years when
Well,
this thing is up? So any good LO is always thinking down to the road to what is next, right? So
Right.
we want to help our borrowers get in front of that so that they're ready to deal with whatever's
Actually,
coming.
that's a good thing about exit strategy. So what are the exit strategies for most borrowers who take this loan out?
If they haven't partially prepaid, they would have to use either the assets that earn money, or they would have to do a cash out refinance if they're still
Yeah.
in their house.
That's right.
I mean, we'll likely have a 15-year towards the end of the year, but at this point in time, the investor is sticking to a 10-year.
A 15-year fixed term.
Yes.
Right.
Yeah, I mean, to your point that you've made with us is we can expect all of this to evolve as these products. I mean, there seems to be some appetite for this on the secondary market. Yes.
Yes.
And
I-
so
If you look at the volume that's being done in the fintech space, and again, that's a product that mathematically is there. It's mathematically, I haven't seen a scenario where the borrower in our engagement would ever pay more in any home price scenario. That's a big statement, but I keep trying to find it, but I can't find it. So there's a lot of people doing these deals in the fintech space. So we think it's going to flow well into the mortgage space.
interesting. So we have a comment from an AE here that says Fannie doesn't allow a second that has negative amortization. So just something to consider as you're going through this process and figuring out who fits. And to the point that you guys made with us originally, it's not for everyone. So
Right.
we just make sure that we are getting ahead of these things when we're looking at, does this make sense for someone? Yes.
Correct.
Yeah, no, you definitely have to look at the full profile of the borrower. As we've done, you can tell we're capping how much we advance. We're adhering to the high cost limits. But I mean, I'll make a prediction. Maybe we'll come back on your show a year from now. The agencies are kind of interested in this product.
Okay.
California did a program for first-time home buyers. That's clearly not our borrower, but there is the idea of shared appreciation in the mortgage space, not outside the mortgage space, is being socialized readily and rapidly throughout the industry right now. So it's true, Fannie doesn't allow that today. I'm not certain that's going to be the case tomorrow.
You're totally, you know what? Now that you say that, California Dream for All, exactly. It is shared appreciation. And
And-
everyone's jumping all over that like it was the second coming of, well, something.
Well,
And so that's true.
It also is
Interesting.
a mortgage, but because they're a state agency, they don't have to adhere to anything.
Ah,
I don't mean that in a negative way, but the year of hoops we jumped through, they were able to exempt themselves from a few of those things. Good program for a first-time home borrower.
right.
A great program if you're a first-time home borrower and you're able to offer that to your clients, go. But that's not going to be a mass marketed product because of the nature and the origin and the source.
Well, they don't have the
And the
funds.
LTV, well, it can't be a first time home buyer. Well, that would be, but yours can't be because you have to live in the house for 2 years.
2 years.
Yeah. No,
Okay.
we're trying to draw a distinction, but I do think the agencies, I know the agencies are interested in this product as a mortgage because, we're adhering to all of the things that we all have to adhere to in the mortgage market. Whether that will carry the day, I don't know, but Fannie has changed guidelines over time. I'll leave it at that.
Well, I'm glad that the conversation is being had because I feel like I keep saying that we should just throw all the guidelines up in the air and start over again. There are so many things that don't work for borrowers in this time and place, whether it's, the way that people have jobs or second jobs or the gig economy or, all the roommate income, all that is in a flux right now in the real world, but hasn't really
Right.
reflected itself into underwriting guidelines at all. And it's a problem for a lot of people. And so it'd be nice if there was some awareness of that at, some of our little regulators and some of the rules were adjusted accordingly, right?
Right.
Yeah. Oh my gosh. Okay, so what else should we know that we don't know? And yeah, what else do you want to let us?
I have a quick question. So and your frequently asked questions, one of them was that would this be a good short-term loan? And basically the answer was no, but I wanted to maybe explain why if I owned a $1.5 million home and I wanted to come up with my down payment and use this product for the down payment on a new property that I want to purchase.
Let's use the $1 million home because the math is just,
Simple.
it's a little simpler. We take the $1 million home and we say it's worth 950,000. That's called the initial agreed value. It's a 5% discount to the appraised value. So if home prices don't appreciate and you pay off the loan in 180 days, you owe me a percentage of that $50,000 on top of the 4.5%, which will cap out on a very short-term basis. So think of it as borrowing money from me at around 11 or 12%, which isn't necessarily a bad rate for the purpose you're talking about. But, you know, my investor would rather you be in the home longer.
Got it.
Because they are an investor who doesn't mind getting their money back 10 years from now. So if your alternative is to pay 11 or 12% to build your house and then convert that to a permanent loan, or I don't know how you would build another house and then convert that to a permanent loan, then this isn't necessarily a bad rate, but you're not really taking in my opinion, the borrower's not taking full advantage of the loan.
Okay.
Right. It really sounds like the person who would be the best candidate for this understands of the value of their money, better used somewhere else. Yes.
Yeah, absolutely. The person that doesn't want to pay the 401k penalty, doesn't want to pay the capital gains taxes, doesn't want to sell at the market bottom, you know, has housing wealth. Someone that thinks about their personal balance sheet and extrapolates that and goes, oh my God, you know, 40% of my worth's in my house, 50% of my worth's in my house. And I mean, how many people can say that after the run from 17 to 21? A bunch of us.
Yeah, lots of people. I mean, a lot of people, but there's a lot of people, again, with credit cards, debt where it is, et cetera, et cetera. A lot of people out there who are really strapped right now. And so they need to get out from underneath their credit card debt. And so this is just another potential option. You know, we'll see whether you want the people who are like, you know, being drowned in credit card debt or not. But if it can improve their situation and give them a situation where, okay, now I'm replacing all that credit card debt and those payments with no payment, and I know I'm going to be fine in 10 years, then great. You know, it might be just the thing, right?
Yeah.
So
again, think of that 76 billion number. I was shocked.
that is shocking. Again, to recap, that's 76 billion in 401k money that was withdrawn. So, and again, that means that person doesn't have that money for retirement. That's a very sobering number if you really think about it down the road. Those are people that are going to retire with less than they need. So if you're offering an alternative to that, it may be just the thing. So holy guacamole. All right. Well, we've had a lot of really good questions. Let me just make sure we don't have anything else we need to address before we call it.
Tom, what's your phone number for audience wants to
well, we're going to send out an email with their contact information and
well, you're not giving Tom's cell phone number out?
Well, I mean, we can write it on a bathroom wall if that's what he wants, whatever, but I just thought it might be easier and maybe he'd prefer an email over a phone call. What do you want,
Yeah,
Tom?
and we have an 866 number that comes in that's manned not only by me but others, just to ensure that we get back to you in a timely manner.
All right, so why don't you tell us what that number is?
Oh, let's
Or not.
see here.
Or you could just go to newfi.com/equity choice WS.
There you go. That's it. That's it. So we'll send out an email with everything that you guys need to contact NewFi, and then you'll be directed to any other questions that somebody might have, et cetera, et cetera.
Right.
Okay.
We'll
All right. Well, that sounds great. Well, thank you guys. This was really interesting. And, you know, it's something for all of us to really think about and chew on. And maybe there are borrowers that we have in our databases that need something just like this. So it'll be interesting to see how it goes.
Encourage you to get in contact with us as soon as possible so we can get you rolling.
Yeah, exactly. And you guys are, if you need to get somebody approved with NewFi to get this done, you'll make that happen sooner
make it
rather
happen.
than later, right?
Correct.
Okay, great.
Nice.
All right. That sounds good. All right.
Right.
One last
Thank you,
smile
guys.
for everyone, Pat.
Was
All
that?
right. Well, we will see you next Tuesday at 11 a.m. Pacific time. And thank you again for being here today. Have a great week, everyone.
Thanks, you
All right,
guys.
Thanks,
guys.
everybody.
Bye-bye.